So imagine this. It's June of 2026, and a publicly traded company, one that is generating, essentially zero revenue from any actual commercial products, suddenly sees its stock price violently skyrocket.
Yeah, up like 150%
Yeah,
in just a matter of days.
right, 150%. And the crazy thing is, the catalyst for this massive market run wasn't some groundbreaking new patent.
No.
It wasn't them opening a state-of-the-art manufacturing facility or anything like that. It was literally just a single non-binding piece of paper from a customer that, well, upon closer inspection, barely even seemed to exist.
Which is just wild to think about.
It really is. So welcome to the deep dive. Today, we are looking at a comprehensive, up-to-date equity research report on Hyliion Holdings, ticker symbol HYLN. And our mission today is to kind of cut through all this extreme stock market volatility surrounding the company.
Because there's a lot of it.
Exactly. We want to help you figure out if Hyliion is, actually engineering a true thermodynamic revolution, or if it's just a precarious house of cards propped up by Wall Street's insatiable appetite for literally anything related to artificial intelligence.
Yeah, and the situation unfolding around Hyliion perfectly encapsulates a much bigger systemic issue in today's market. I mean, investors are acutely aware that artificial intelligence requires just an unprecedented amount of electrical power.
Oh, absolutely. The demands are insane.
Right, and the global grid is already bottlenecked. So this creates an environment where the market is desperately hunting for infrastructure solutions. And because of that desperation, they are sometimes completely mispricing the difference between an engineering concept and a scalable commercial reality.
Which brings us to you, the listener. We want you to step into the shoes of a forensic Wall Street analyst with us today. We're going to separate the underlying physics from all this blinding financial hype.
It's a very necessary separation.
Yeah. But before we get to that 150% stock spike and the whole short seller attack that ended up slashing it in half, we first need to ground ourselves in what Hyliion actually builds.
Right, the technology itself.
Exactly. So the company is essentially pre-commercial, and their entire future rests on something called the Carnot power module, which the research report describes as a linear generator.
Yes.
So let's start with the mechanics. I mean, why is a linear generator theoretically better than the traditional generators we've been using for, a century?
Well, to understand the value proposition, you really have to look at the inefficiency of a traditional power generator. I mean, for decades, we have generated electricity primarily through rotational mechanics.
Okay, meaning things spinning around.
Exactly. You burn a fuel to create expanding gas, which pushes a piston to spin a crankshaft, or, you use steam to spin a massive turbine.
Right, like in a traditional power plant.
Yeah, and that spinning motion turns a rotor inside a magnetic field to actually generate the electricity.
Mm-hmm.
But rotational mechanics are inherently inefficient. You lose a tremendous amount of energy to mechanical friction, to heat, and just to the sheer physical resistance of all those moving parts.
So it's basically wasting energy just trying to turn itself.
Precisely. Now, a linear generator completely eliminates that rotational aspect.
Mm-hmm.
Instead of spinning a shaft, the Carnot module uses a heat source to drive a piston back and forth in a straight linear motion.
Just right back and forth.
Right. And that piston is directly integrated with powerful magnets.
Okay.
So as it oscillates back and forth through copper coils, it generates electricity directly.
Wow, okay.
Yeah, by removing those rotational linkages, you drastically increase the thermal efficiency and you massively reduce the physical wear and tear.
Which is exactly why the AI data center market is supposedly salivating over this thing. I mean, a data center operator doesn't want a generator that requires a team of mechanics to, lubricate gears and replace bearings every month.
No, they want zero maintenance if they can get it.
Exactly. They want a closed-box system that provides a massive, uninterrupted base load of power with near zero mechanical friction.
Right.
But, and this is a huge but, having a brilliant blueprint and having a profitable business are two very different things.
Very different.
Yeah, because looking at the financials in this research report, their Q1 2026 revenue was just $2.8 million.
Which is tiny.
Tiny. I mean, sure, that is up from $500,000 the year prior. But the critical detail is the source of that money. It is entirely driven by research and development services for the Office of Naval Research. None of it is from actual commercial product sales.
Zero commercial sales. And furthermore, that $2.8 million in R&D revenue is just completely dwarfed by the capital required to run the operation.
Oh, the cash burn?
Yeah. Hyliion posted a net loss of $11.7 million in that exact same first quarter. And when you zoom out and look at their trailing 12-month net margin, it sits at a staggering negative 888.12%.
Wait, negative 888%. That's almost hard to comprehend.
I know. You are looking at an entity that is aggressively burning cash to solve complex engineering problems. They are not a manufacturing company printing reliable margins.
Okay, let's unpack this. Because looking at these fundamentals, the gap between having a prototype and their actual valuation is just vast. I mean, they boast about this 500-unit non-binding order book, but the research specifically flags a severe supply chain vulnerability.
Ah, yes, the magnets.
Right. To make a linear generator work efficiently, you need the piston to generate an immense electromagnetic field, and that requires highly specialized, high-strength, rare earth magnets, specifically neodymium.
Which is a huge bottleneck.
Exactly, because currently China completely dominates the mining and processing of those materials. So you have a pre-revenue company bleeding cash trying to revolutionize thermodynamics, while their critical path to manufacturing is fundamentally tied to a major geopolitical choke point.
It's risky, to say the least.
Right. So how does a company in that exact position sustain a market valuation of nearly $700 million with a price-to-sales ratio of over 120?
Well, what's fascinating here is how thematic momentum can just completely override traditional valuation metrics. When institutional and retail investors see a price-to-sales ratio of 120, they are not assigning a multiple to today's Navy R&D revenue.
They're ignoring today entirely.
Exactly. They are attempting to price in a monopoly premium on tomorrow's energy grid. But moving from a highly customized prototype that satisfies a government research grant to a standardized unit deployed globally in data centers requires mastering manufacturing logistics.
Right. Building one is easy. Building 10,000 is hard.
Exactly. It's a difference between a master aerospace engineer building a single, flawless experimental jet in a hangar versus designing a fully automated assembly line that can produce 500 reliable commercial airliners a year without a single defect.
Yeah.
Engineering the prototype is only the first step. Engineering the factory that builds the prototype is exponentially harder.
And the market desperately wanted proof that Hyliion was ready for that factory phase. The investors wanted proof of commercial demand to, justify that $700 million valuation.
They needed a catalyst.
Right. And the company attempted to deliver that proof, which is the exact moment the story transitions from a difficult engineering challenge into absolute financial chaos.
Oh, total chaos. The market was basically a powder keg of AI infrastructure demand, just waiting for a spark. And Hyliion provided that spark by announcing a massive letter of intent, or LOI.
Here's where it gets really interesting. Hyliion announced an agreement for 250 units, which represents an estimated $133 million in future revenue, with a company called VFG Holdings.
And the narrative was just perfect.
It was too perfect. VFG was going to use these Arno modules to power AI data centers. The algorithms and the retail traders saw those three words, AI, data centers, and millions, and they just aggressively hit the buy button.
They didn't even look twice.
No. The stock price went on an absolute tear. It shot up 150% and peaked at $8.49 a share in June. The market priced this non-binding LOI as if the cash had already cleared the bank.
Which is always a dangerous game.
Right. But then an activist short seller firm called Pelican Way Research decided to, actually look under the hood of this counterparty.
Yeah, and the forensic work done by that short seller is a masterclass in due diligence that the broader market just completely skipped. I mean, Pelican Way didn't just critique the linear generator technology. They went straight to the source of the demand.
They looked at VFG itself.
Right. They pulled the incorporation records for VFG Holdings and found it was a newly minted entity incorporated mere months prior in January 2026.
Wait, so it was basically a brand new company.
Exactly. It wasn't some entrenched utility giant.
No. The short report highlighted that VFG had a virtually non-existent online footprint. They had an office address that looked highly questionable for a major infrastructure player.
Very questionable.
Yeah, and most importantly, they appeared to completely lack the capital backing or even the physical real estate portfolio required to actually take delivery of, install, and operate 250 multi-million-dollar power modules.
They just didn't have the capacity.
Right.
They essentially exposed that the entity anchoring a 150% public market rally was, for all intents and purposes, a paper tiger.
And when that report dropped, the market reaction was violent. Hyliion's stock tumbled over 50%, crashing right back down to $3.92. The stock now trades with a beta of 3.65.
Meaning it's insanely volatile.
Yeah, meaning it is experiencing price swings more than 3.5 times more extreme than the S&P 500.
Wow.
This sequence of events reveals a deep psychological flaw in how public markets currently evaluate thematic technology. I mean, a letter of intent is precisely that intent.
It's not a contract.
No, it is a non-binding framework indicating that two parties are just talking. Companies utilize LOIs to demonstrate early commercial traction and to guide their internal supply chain forecasts.
Sure, which makes sense internally. But in an environment characterized by extreme FOMO fear of missing out, investors routinely misprice non-binding intent as binding infrastructure. The short seller basically functioned as the market's immune system here, forcing investors to acknowledge the counterparty risk. When your momentum is built on unvetted paper promises rather than legally binding cash-on-the-barrel purchase orders, it takes very little to shatter the illusion.
And since that illusion of immediate commercial dominance has been shattered and the stock price has been slashed in half, the fundamental reality of their balance sheet comes right back to the forefront.
Yeah, math doesn't lie.
Right. Hyliion is trapped in a classic pre-commercial bottleneck. Looking at the numbers, they expect to burn through roughly $50 million in operational cash in 2026 alone.
That's a huge burn rate.
It is. And that burn rate will leave them with an estimated $100 million in cash and short-term investments by the end of the year. Now, the company's official public guidance states they expect to achieve early commercialization of their 200-kilowatt Carnot module by late 2026.
But the tension lies entirely in the timeline.
Exactly.
Hyliion projects late 2026, but the independent equity analysts cite significant skepticism. They suggest that supply chain realities, like those Chinese rare earth magnets we talked about, and just general manufacturing scaling hurdles, could easily push actual commercialization out to 2028.
Okay, so if you are burning $50 million a year and you only have a $100 million reserve buffer, a 2-year delay to 2028 is the literal definition of the Valley of Death.
It's game over for the cash runway.
Right. It guarantees the company will run out of operational capital before they can manufacture a single product to sell. They would be forced to go back to the capital markets to raise emergency funding, which, I mean, at these depressed stock prices, would result in massive punishing dilution for any current shareholder.
Absolutely brutal dilution.
And we can actually gauge how the people inside the building feel about navigating that Valley of Death by looking at the insider trading metrics in the report. Over the past 90 days, there have been 12 insider sell transactions, shedding over 76,000 shares.
And how many buys?
Exactly zero. Zero insider buy transactions during that same period. When the executives holding the blueprints are systematically rushing for the exits, it severely undercuts the public messaging that commercialization is right around the corner.
Oh, for sure. I mean, insider selling can sometimes be attributed to tax obligations or, scheduled diversification.
Right.
But 12 independent sell transactions with zero corresponding buys.
It's hard to ignore.
It is a glaring metric of executive sentiment. It signals an internal recognition of the massive execution risks ahead.
I do want to push back on the pure bear thesis for a moment, though.
Okay, let's hear it.
Because just when you assume the technology might be vaporware, you look at their government pipeline. Hyliion recently secured a highly structured $41.7 million contract from the U.S. Navy for larger 2-megawatt and 3-megawatt Carnot systems.
That is true.
Right. And the Office of Naval Research does not just hand out $40 million to shell companies. They have teams of mechanical engineers who audit these technologies. Doesn't that rigorously vetted military contract validate the core physics of the linear generator?
Well, this raises an important question regarding the definition of validation in the context of public markets. You are entirely correct that the Navy contract validates the underlying physics.
Okay.
It proves that a linear generator can, in fact, produce highly efficient power in a controlled or bespoke environment. Moreover, because it is structured as a cost-plus fixed-fee contract, the government basically assumes the risk of cost overruns.
Right, providing Hyliion with a crucial risk-free financial lifeline to keep their engineers employed.
Exactly. But the economics of a military research project are diametrically opposed to the economics of a commercial data center.
Because the military doesn't care about unit economics in the same way.
Precisely. Designing a specialized 3-megawatt behemoth where the Navy covers all the R&D overruns is a distinct discipline from mass-producing a compact 200-kilowatt module that must hit strict, unyielding unit economics for a commercial buyer.
Right. A data center operator is not going to cover your manufacturing cost overruns.
Never. They demand a fixed price, a guaranteed return on investment, and absolute reliability. The Navy contract proves the science is real. It does not prove the commercial business model is viable. It does not answer the question of how Hyliion will scale their supply chain, and it certainly does not bridge that potential 2-year delay that threatens to wipe out their cash reserves.
Which means the company's margin for error is essentially zero. The science works, but the business is bleeding. So looking at the next 6 to 12 months, how do they actually engineer their way out of this before the money runs dry?
It's tough.
Yeah, the research outlines a very narrow path to recovery, heavily relying on those late 2026 deployments to early adopters.
And those engineering milestones are critical. I mean, they recently cleared a significant hurdle by achieving UL certification.
Which is huge.
It is. For any listener unfamiliar with industrial hardware, UL certification is non-negotiable. It is an independent safety science certification that proves the machine meets strict electrical and fire safety standards.
Right, you can't just plug something in and hope it doesn't catch fire.
Exactly.
Okay.
You cannot legally connect a multi-megawatt generator to the grid or place it inside a billion-dollar data center without it, because no insurance company on Earth would underwrite the facility.
Right, so that clears the safety regulatory hurdle, but the report stresses they still need to demonstrate consistent nameplate power output.
Which is the real test.
Right, and this isn't just a marketing term. In grid infrastructure, nameplate capacity means the machine can continuously generate its maximum advertised wattage in a real-world environment, 2047, without suffering from thermal degradation or mechanical failure.
It has to run perfectly, all the time.
Exactly. Until a commercial buyer sees that unit humming flawlessly on site, meeting the exact specifications of the brochure, it basically remains an expensive science experiment.
And clearing those engineering hurdles only serves to unlock the final, most vital catalyst, converting the paper promises into binding contracts.
The actual money.
Right. The market is waiting to see if Hyliion can take that non-binding LOI pipeline, including the controversial VFG Holdings deal, and translate it into firm, legally binding purchase orders accompanied by upfront cash deposits.
Because cash talks.
Exactly. A binding purchase order is the only mechanism that instantly silences short sellers, because it proves tangible commercial demand and provides a contractual foundation for future revenue.
But until they can produce that binding contract, the research report takes an uncompromising stance. They issue Hyliion a final rating of 4 out of 10, classifying it as neutral but specifically cautious.
Very cautious.
Yeah, the analysts explicitly deem the stock uninvestable on a fundamental basis at these current levels until actual commercial demand is proven.
Which is a harsh verdict.
It is. So what does this all mean? Looking at the cash burn and the complexity of scaling a global manufacturing footprint from scratch, it seems incredibly unlikely they can navigate this valley of death alone.
No, they probably can't.
Right. The only logical path forward might be abandoning the dream of being an independent manufacturer and instead securing a strategic partnership with a legacy industrial titan.
Someone like a Siemens or a General Electric.
Exactly. Someone who already possesses the automated factories, the supply chain leverage to secure those Chinese magnets, and the capital to weather a 2-year commercialization delay.
Well, if we connect this to the bigger picture, your theory highlights the intensely binary nature of deep tech hardware investments. I mean, if Hyliion manages to survive the cash crunch and successfully commercializes an efficient linear generator precisely as the global AI power crisis peaks.
The upside is astronomical.
Astronomical. They would own the foundational intellectual property for the next generation of grid infrastructure. However, the downside risk currently priced into the stock is profound.
Total wipeout potential.
Exactly. The valuation reflects immense execution risk, vulnerable supply chains, and a reliance on purely hypothetical demand. Investing in Hyliion today requires accepting that you are not buying a stake in a functioning business. You are funding a high-stakes engineering wager.
And it has been an incredibly chaotic wager to watch unfold. I mean, we have tracked a company that genuinely secured rigorous military validation, only to get swept up in a 150% thematic stock rally fueled by a questionable shell company.
Just a wild ride.
Yeah, and then they got brutally dismantled by forensic short sellers and are now left racing against a $50 million annual cash burn while their own executives sell off shares. It is a masterclass in why analyzing the balance sheet is just as important as analyzing the blueprints.
It serves as a stark reminder that in the public markets, possessing a revolutionary thermodynamic concept is perhaps, 10% of the equation?
Maybe even less.
Right. The remaining 90% is ruthless operational execution, transparent corporate governance, and flawless market timing.
Which leaves us with a final thought we want you to mull over as you analyze your own portfolios. The Hyliion saga forces a critical reevaluation of how we perceive infrastructure in the AI era.
It really does.
As the artificial intelligence arms race accelerates, energy has become the ultimate global bottleneck. Investors are so terrified of missing out on the next big infrastructure boom that they are willing to blindly misprice intent as actual execution.
Which is a dangerous trap.
It is. So as you look at the wider market, you have to ask yourself, how many other heavily hyped pre-commercial companies are currently being propped up by non-binding letters of intent from obscure entities? What hidden geopolitical supply chain risks are lurking inside the order books of the next big tech trend you decide to invest in?
You have to look deeper.
Exactly. Don't just read the headlines, read the incorporation documents of the companies signing the checks. Keep digging, keep questioning, and we'll catch you on the next deep dive.